Hey everybody, Rob Maurer here, and today we're going to be doing a little bit of previewing for Tesla's Q3 earnings call tomorrow. Then we did actually have a handful of other interesting news, so we'll hit that first and quickly start off with the stock here. Tesla up 0.4% on the day today, closing at $254.92. Actually a nice outperformance with the NASDAQ closing down 0.25%, but of course not super meaningful as we head into earnings tomorrow, which will have a much greater impact. So we'll go through the estimates and preview a little bit here later on, but first want to touch on a couple pieces of news. One big one, BMW has announced that they are going to be adopting the North American Charging Standard, or NACS, to allow their vehicles access to the supercharger network in the US and Canada in early 2025. So yet another automaker jumping on board. I think we've just still got a couple of major holdouts from the likes of Volkswagen and Toyota, but the dominoes continue to fall. A couple of big ones here with BMW and Hyundai Kia over the last week or so. So good to see that. Interestingly, they did not mention, like we have heard from other automakers, an adapter. So a lot of other automakers have mentioned an adapter for NACS prior to the adoption, or the integration rather, of NACS into their vehicles. But through this press release, no mention of that from BMW. So we'll see. You know, they might have just left that out, but kind of an interesting difference between the announcements. But of course, for BMW, this will cover the BMW brands as well as the Mini, and interestingly enough, the Rolls-Royce brand as well. I think they just announced announced or started delivering the new $400,000-ish EV, so maybe some people will happen across those at superchargers in a couple of years. All right, then the other interesting one is GM today confirmed that they will be retiming the conversion of their Orion assembly plant for EV truck production to late 2025. This was scheduled originally to happen next year. They say that this is to better manage capital investment while aligning with evolving EV demand. In addition, they say that they have identified engineering improvements that they'll implement to increase the profitability of their products. So what did we talk about a couple of weeks ago? How it's starting to get to a period of time where it's difficult for these automakers to actually make these investments. And a couple of weeks later, here we sit with GM delaying a significant investment for EV production in the truck part of their business. They did, to be fair, say that they're going to produce the Chevy Silverado EV, the GMC Sierra EV that were supposed to be produced at the Orion facility at their Factory Zero in Detroit, but presumably at much lower volumes than what they had initially intended, or at least initially said that they intended to do at the Orion assembly plant. So again, very interesting announcement here from GM. This follows just yesterday we talked about Ford reducing their shift count on the Ford F-150 Lightning. There seems to just continue to be a little bit of hesitancy right now during this period as demand for vehicles, demand for EVs, especially with the pressure that Tesla is putting on in the segments that Tesla occupies, but also soon to be with the Cybertruck. It's just becoming a more difficult proposition for these companies to make these multi-billion-dollar investments that they really need to be making right now. Otherwise, we're going to get to a point where it's too late. They're just too far behind. And other companies, such as Tesla primarily, take that volume and, once that's gone, it's much more difficult to get back than it would be to sort of maintain it. So again, it's a fascinating period of time right now, and I think, an announcement like this is probably not the last type of decision change that we'll see. And I think no real surprise that it's coming from General Motors. They like to rely a lot on their announcements, but, as it needs to come to fruition, I don't know that we're really going to see a whole lot of that. So we'll continue to keep an eye on that, but pretty interesting update from GM today. All right, next, just a quick one. There was a recall announced today for Model X vehicles between 2021 and 2023. It's about 55,000 vehicles. This is an over-the-air update, so really not worth talking too much about. It is for a brake fluid indicator, but Tesla's fixing this with a software update, so nothing too major, but of course, always generates headlines. And then we did also get updated China insured vehicle numbers overnight. So for the week of October 9th through the 15th, 7,500 vehicles insured in China. So a little bit of a bounce back, obviously, from the Golden Week, first week of October, where there was, holiday in China, things like that impacting these numbers, and of course the transition to Q4. But we'll likely continue to see these numbers grow in the coming weeks. And then Lucid, after a short period of delay here, has finally announced their production and delivery numbers for the third quarter. So for the third quarter, they produced just over 1,500 vehicles, plus additional 700 vehicles that are in transit to Saudi Arabia for final assembly. So if you consider those produced, maybe about 2,200, 2,300 or so. and they also delivered just under 1,500 for the same period. So if we look at our production versus delivery tracking chart for them, kind of interesting. We've seen production now fall for basically 4 straight quarters, depending on whether or not you include that 700 vehicles in actual produced vehicles. But then deliveries now kind of stagnating after the peak in Q4, right around 1,400 a quarter, when, 3 or 4 quarters ago, they were producing as many as 3,500 vehicles a quarter. So they now have about 4,500 vehicles in supply. If you do the same days of inventory calculation that we do for Tesla, or that Tesla posts in their earnings report, that would put Lucid at 270 days of inventory before you even consider the 700 vehicles en route to Saudi Arabia. So if you include those, then it's more like 275 days. That actually held steady quarter over quarter. It was about 243 last quarter. So, I guess that's good. But obviously for Lucid, you'd really want to see these delivery numbers picking up, and they've, again, kind of stagnated there. So we'll continue to keep an eye on them, but obviously their cost structure is built for much higher levels of deliveries, and even that is going to be a challenge economically. So not looking great for Lucid right now. And then we'll get into the Tesla earnings report. So that is going to be after market close tomorrow. So we'll do the same thing as normal. We'll just kind of review the letter as it comes out, look at the financials and the updates Tesla's got in there. And then the earnings call will follow about an hour and a half after market close, 4:30 Central Time. And I'll stream that on the channel as well. So hopefully you'll all join me for that. And then before we even get into the numbers and some of the expectations, just a quick reminder, we always do this to try to understand the business better and understand the trajectory of the business, put context around some numbers so that people, don't just look at a bottom line number and kind of judge the business based on that. Better to get a holistic understanding. For example, this quarter, something that's important to be aware of. Last quarter on the other income line, that was positively impacted by foreign exchange movements. That other income line was positive $328 million, so that's significant. And that significantly contributed to the earnings per share number that gets reported, net income that gets reported. So just stuff like that. That's why we, look at these in detail and try to put context around some of these things. So that being said, let's hop into some of my expectations. Let me flip over to Excel here. I'm actually going to take a drink of water too, because my mouth's going to dry up. So give me a second. All right. So as you guys can see, we already know deliveries from Tesla's earlier release. So 435,000, the analyst consensus actually got it right this time. Usually that's off a little bit because people don't update their numbers, but they have now updated it. So it's good to see that. Energy storage, I'm expecting a bit of an increase here. So we'll just kind of go through and look at my numbers, look at consensus, look at things to kind of keep in mind. One other point that I want to make before we get into it, I guess, slipping my mind, but we'll get to it. So just to look at some of the numbers, I'm expecting about 4.5 gigawatt hours of energy storage. Analysts are at about 3.7 gigawatt hours. I'm a little bit higher because last quarter we actually saw a decline after a pretty significant increase the last couple of quarters. So as we've talked about energy storage deployments, the recognition of those rather, it can be a little bit lumpy depending on when projects are commissioned or when they're, turned on in operation. So for this, I'm just kind of expecting a little bit of a bounce back to the trend that we had been seeing. We know Tesla's capacity is continuing to grow. So we may not see it this quarter. It's really just a guessing game for all of us. There's not great tracking on energy storage yet. But I'm kind of expecting that to bounce back. Analysts kind of expecting it to stagnate. Could be either one. I'm just a little bit higher. And then energy generation, obviously that'd be for solar. I'm at 75 megawatts versus 89 for analyst consensus. So I'm a little bit lower just because we've seen, not much progress in that over the last couple of quarters. High interest rates could be affecting the solar business. Of course, there's seasonality there, certainly in Q1, but hopefully we see that continue to or bounce back a little bit. My expectations, though, are not super high. All right, so as we get into the revenue lines, just something to keep in mind for this quarter. I think probably the biggest unknown is going to affect these lines, and this is, pretty typical for Tesla. I think the biggest unknown this quarter is average selling price combined with average cost of goods sold. So as we've been seeing, this has been, declining significantly quarter over quarter for the last few quarters as Tesla has cut prices. Interestingly, list prices this quarter were actually pretty stable. However, Tesla did offer a lot of inventory discounting. So because we don't really know the mix between people purchasing from inventory, people purchasing from the design studio for a new order, it makes it very difficult to understand what the mix is going to be between those and therefore what the average selling prices are going to be. Versus in past quarters, you can kind of just take a look at Tesla's list prices and see how those changed quarter over quarter. This quarter, we can't really take a look at that because we have that inventory discounting factor at play. And then, of course, for the Model S and Model X, there were significant price changes in September. So that's factored in here. But otherwise, for 3 and Y, it's kind of just taking a guess as to how big that inventory discounting impact was. So all that being said, I am showing a decline in average selling prices by about $1,100, which is pretty similar to what we had seen last quarter, a little bit less than we saw heading into this year in Q1, quarter over quarter changes. So I'm just kind of expecting that to continue based off of, again, S and X decreases and inventory discounts, but really, really tough, I think, to get a gauge on that. And that's going to really affect everything from this, very start top line on down. And then for cost of goods sold, we did see a decline last quarter of about $600 per vehicle. I'm showing a little bit more than that this quarter, about an $800 per vehicle cost decline. There's going to be a few factors at play there. The biggest factor for me that's causing that decline is 4680s. That's been weighing on this number ever since it started getting bucketed here versus R&D. So it's roughly been a couple $100 million a quarter. As Tesla increases production, makes cost of goods sold, or improves the cost efficiencies of 4680s in general, that's going to stop being such a big hit. So we've seen that improve quarter over quarter, and I'm kind of expecting that to continue. And that's really the biggest driver for me on my average cost of goods sold decline quarter over quarter. As we see that, we saw Tesla announce the 20 million vehicle production number. 20 million cell production number, which showed really good progress on that. So I'm kind of expecting that to drive the cost improvements, and then kind of maybe pushing things a little bit in the other direction. We did have, of course, the changeover in Model 3 for Highland, and we don't necessarily know how impactful that's going to be on the cost structure. Hopefully over time that brings the cost structure down, but as that transition happens, there's likely going to be some additional costs associated there, so that's going to push things in the other direction. And again, it's a little bit of a guessing game as to how those impacts weigh out. But because Tesla transitioned so quickly, I'm kind of expecting that to be rather minimal in terms of the impact this quarter. So hopefully that'll be the case. At any rate, again, showing about an $800 decline in cost of goods sold. So that kind of takes us into margins and profitability. You can see here I'm actually showing increases in automotive gross margin, and we'll talk a little bit more about that here in a second. One of the main drivers of that, as we can see if we go back up to automotive sales, is regulatory credits. So the regulatory credit sales for Q2 were relatively low, as we can see $282 million last quarter versus $521 million in Q1. So that declined pretty significantly. I generally just kind of guess, an average over the last few quarters for Tesla on this bucket. So I'm at about $325 million there, which is, helping drive profitability a little bit more than last quarter. And then one of the really big things here that is increasing my forecast is FSD deferred revenue. So this is a wild card for this quarter, as it is for every quarter. Just a reminder from Tesla's 10Q that they published after the Q2 earnings report. They said that they expect to recognize $747 million of deferred revenue related to FSD and some other items over the next 12 months. So I'm expecting a decent chunk of that to come this quarter. I've got $200 million of FSD deferred revenue in my forecast, which is going to boost things like margin and revenue, obviously, as well. So that's a pretty major impact. Obviously, that's going to have really low cost of goods sold, so it boosts revenue without much of an impact on cost, which boosts margins. And the reason I have that is because in September, Tesla adjusted the design studio where it used to list coming soon for AutoSteer on city streets, and they dropped that coming soon label in association with some of the broader rollouts for FSD 11.4, etc. So because of that, I'm expecting them to recognize some deferred revenue. I don't think analyst consensus probably has much of that in there, if any. So that's going to be a major factor driving some differences between my forecasts on profitability. So as you can see, we kind of skipped over revenue a bit, but for total sales, I'm at about 24.1 billion versus analysts at about 23.9 billion. If you assume there's no deferred revenue in there, and again, we don't have the regulatory credit forecast specifically, but if we assume that that's not in there, then my revenue figure would be roughly the same as theirs. So we'll see on that. If that doesn't happen, then I would just kind of take that out of my forecast, and that would make it a little bit more comparable. But we'll see. And then just to kind of, again, sorry, I skipped over the revenue lines for energy and services and others. But because we talked about them up here, so energy I have growing a couple $100 million quarter over quarter with that, additional 1 gigawatt hour. Basically, I've got a lower average selling price than last quarter because that spiked up a bit. So I've got that declining a bit, which is why the energy storage growth would be a little bit bigger than the revenue growth, but we'll see on that. I'm a little bit higher than consensus, but not too much given, how far above I am on the actual storage deployed. And then for services and others, services and other, I'm at about $200 million increase quarter over quarter, so roughly 10 or 11%, which is kind of similar to what we saw last quarter. That growth was a little bit higher than what we had been seeing, so Tesla attributed that, I think, to used vehicle sales and things like that. We'll see if that continues. I'm not sure, how big of a factor the FSD beta one-time offering of, swapping that from vehicle to a new vehicle, how that could impact. We might see more used vehicle sales because of that this quarter potentially. So that's kind of what my thinking was on that line. I'm a little bit, pretty significantly higher than analyst consensus on that one. So, I mentioned the couple $100 million of difference. A lot of that is actually from these other lines. My automotive sales line is pretty significantly lower than analyst consensus. All right, so anyway, getting back into profit, we talked a little bit about automotive gross profit. That yields about a 20% automotive gross margin, would actually be an improvement quarter over quarter, even excluding credits. However, that does include the the deferred revenue. If you exclude that, it's actually pretty close to equal quarter over quarter. Energy margins, I do have declining a little bit. We saw those increase significantly last quarter to 18.4% from 11% in Q1. So some might ask why I'm showing a decline here. Just because of the volatility really that we have seen. You can see in Q4 that went from 12% to 11%. I don't think many people would have expected that on significantly higher volume. So I'm just trying to be cognizant of that potentially being the case. 18% is a very, very strong margin, I think, at this point for Tesla Energy, especially as they continue to ramp. So I'm just trying to be a little bit cautious on, my expectations there due to some of that volatility and due to the relatively high benchmark that we're coming off of for the second quarter. So I wouldn't be surprised if this is lower, wouldn't be too surprised if it's higher. We don't have much visibility to it right now. And then for services and other, I'm at 8.1%. We've seen pretty consistent increases here, so hopefully, we'll kind of continue to see that. A lot of factors go into that, used vehicle sales, a bigger portion of the fleet being out of warranty now. That's helping boost service and other margins. So hopefully we'll continue to see that. It's less of a drag on the business at these levels, certainly than it would have been something like a year ago or even 2 years ago when it was likely close to zero or negative. So overall, that gives me about $4.5 billion in automotive profit, pretty close to equal quarter over quarter, actually almost identical quarter over quarter. But again, aided by the FSD revenue included in my forecast and the additional, call it $50 million of regulatory credits. And as you can see, I'm quite a bit higher than the analyst consensus for gross profit. Now moving into as we travel down to the bottom line through the operational expenses. For R&D, I'm continuing to show a big increase here, or small increase here. We did see a big increase last quarter from 771 million up to 943 million. I believe Tesla mentioned that in large part was due to things like Cybertruck starting to hit the R&D line. So I'm kind of expecting that to continue to keep this line high as we continue to go on in the next few quarters. As Tesla puts that into production, I would switch some of these costs back from R&D to cost of goods sold. Like we had seen with 4680s initially, we saw a big jump in R&D, and then that sort of switched lines back into COGS. So that's what I'm kind of expecting to happen there, but that won't happen in Q3 yet because we have not seen deliveries. Then for SG&A, kind of similar story there, continuing to expect increases on the SG&A line relating to ramping Cybertruck. Bitcoin and other, we shouldn't really see anything there. So total operating expenses puts me at just under 2.3 billion. You can see analyst consensus is significantly lower, 2.1 billion, yielding 2.1 billion in operating income for them. And I'm still a little bit higher at 2.25, let's call it. So $100 million higher. As we, kind of work through, I have higher profit. They have higher lower operating expenses. So it's getting closer to netting out the same between those two factors. Anyway, I'm at 9.4% operating margin, which is pretty close to last quarter. They're at 8.9%. So I did want to spend just a second on this because of these two forecasts, I would much prefer to have better gross profit and higher operating expenses than sort of the inverse where you've got lower gross profit and lower operating expenses. I think the operating expenses are a little bit less fixed right now and actually are transitory in nature to an extent, obviously, because of the Cybertruck, as I mentioned. So I do expect that these will kind of float back into cost of goods sold at some point, which means that on a sustained basis, on sort of like a fixed business cost basis, these should come down, which means operating leverage should improve. So I'm not too worried if these are a little bit higher this quarter, but if we conversely have, a lower operating margin number driven by lower gross profit, then essentially what that means is there's a little bit less cost improvement on the actual sale of the vehicles than what I was kind of hoping for or forecasting here, or there's a greater fall in average selling prices, which means that, Tesla's got a little bit less wiggle room to work with as they continue to move down that curve. So I'd rather see higher gross profit, lower operating margin due to higher operating expenses than, similar operating income driven by higher operating expenses and lower gross margin. So I'm sorry if that's confusing. Hopefully it's not too bad, but really just saying that I'd rather have, higher margins with higher operating expenses than lower margins with lower operating expenses if you could give me the same operating income number. Anyway, we'll move on to the bottom line here. People always like to look at earnings per share. So I'm at 76 non-GAAP earnings per share, 76 cents non-GAAP earnings per share, 62 cents GAAP. Again, the only difference there is going to be stock-based compensation, which I've got increasing slightly quarter over quarter, as we have seen historically. And then to get your net income, you're just putting in things like taxes and non-controlling interest and stuff like that. But obviously, I'm a little bit higher on that as my operating income is higher as well, yielding my expectations of a slight beat to analyst consensus. However, I got to circle back again to this FSD number because I do have the $200 million in there, which is driving about 5 cents of earnings per share here. So I'd pretty much be in line with analyst consensus otherwise. And I now remembered finally what I was going to say at the beginning. I try to do my forecast. I do my forecast before really looking at any other forecast from anyone else or from analysts or anything like that, as a lot of times there's not a lot of independence of thought on these things. So I think it's better to just kind of do it in isolation and then compare. So although the last few quarters we've ended up in pretty similar spots, I do these before looking at the analyst numbers. So ultimately coming out pretty similarly, but again, a lot of differences in kind of how it nets out to get to that point, which I do think are material. I felt like I probably explained them pretty poorly, but $4.5 billion in gross profit versus 4.2, that's a pretty significant difference and has significant implications for the business going forward, depending on which of these numbers ends up being closer, if either is close at all. So we'll see. As usual, one of the big things I'm going to be watching is that automotive gross margin X credits line. And we got to be careful because there could be things in there like FSD deferred revenue, foreign exchange impact, all these things that can impact it, when we're looking at these numbers as they come in. And then just to kind of reiterate one number that I alluded to as we began this, if we're looking at a quarter over quarter comparison for earnings per share, you can see 91 cents earnings per share last quarter, 76 cents this quarter. Last quarter, though, there was that benefit of $328 million of foreign exchange impact on the other income line. So if you take that out for that quarter, that probably ended up being an impact of, 7 cents, 8 cents, something like that. So these would be closer if you remove that. Obviously, you still have the regulatory credits and FSD deferred revenue on this side in my forecast. But again, it's just something that's important to keep in mind as we see how things are, evolving over time. And then, of course, as we look at the decline here that I'm forecasting quarter over quarter, you got to factor in the downtime, right? There was 466 deliveries in Q2, 435,000 deliveries this quarter, largely related to Highland downtime, and of course, a little bit in Giga Texas as well. With those factors, that's going to be a contributor to the bottom line as well, which is going to reflect in the quarter over quarter decline that I'm forecasting for here. Hopefully that all makes sense. And then just free cash flow. I don't forecast this specifically. Analysts are at about 2.4 billion. I think that's pretty reasonable. I think last quarter they were pretty significantly over forecasted. But this quarter, since we did have deliveries outpace production by about 5,000 vehicles, then that's going to be a contributor to cash flow, depending on what Tesla does with, their work in progress and actual parts inventory and things like that. That'll impact free cash flow, and it's somewhat difficult to forecast those items, but that the deliveries outpacing production should be a positive influencing factor for free cash flow, which should reflect well on Tesla's, cash position when they report that. So I know we went through a lot there, but again, hopefully that just kind of helps set expectations, not even set expectations, but just kind of, set the context, help with understanding as we do get the report tomorrow. But of course, we'll be here to talk about that at that time. So I'm just going to quickly take a look through the comments, but that'll kind of, wrap up the points I wanted to make here, unless I remember anything as I'm looking through here. But I just want to take a quick look in case people have specific questions about the forecast. And thank you guys for bearing with, I know it's maybe not always super fun to just look at an Excel spreadsheet, but I think it's important. I mean, sometimes people, have strong feelings about the expectations being set one way or another for Tesla, and we should just let them report it and go from there. Largely, I agree with that. However, I think it's super helpful to just go through and forecast these things just for understanding the business, right? Like understanding how all these things connect, understanding how, demand relates to the bottom line and things like that, and how all of it flows together and how it changes over time. And I think by doing the actual process of forecasting, I'd recommend it to everybody because it really does help, I think, improve that understanding and just kind of, helps with context around the decisions that Tesla has to make, day to day. So I definitely would recommend that for everybody. All right, just quickly looking through comments here. Bear with me. This will give us a little preview for tomorrow. Obviously, with the earnings episodes, there's some downtime like this. All right, I'm not seeing like a ton of questions here, which is good. Always kind of hard to tell. Yeah, good one here. Any thoughts on possible announcements? That's a good reminder. So I didn't really talk too much about it because I think everyone this time, we're all looking for information on Cybertruck. So hopefully we'll get an update from Tesla on that. I don't know if we'll get a delivery date specifically, but I would imagine that Tesla would reiterate Cybertruck deliveries before the end of the year, which would obviously then be this quarter. So hopefully we'll hear some stuff about that. Maybe some discussion on Highland, since Motor Trend had that vehicle and kind of talked about the release date. Tesla may be a little bit more willing to talk about that, and obviously the impact in the international market are already apparent. 4680s, we'll definitely get an update on that. FSD, I would imagine we'll probably hear a little bit more about version 12. I don't know that we'll hear a lot that's anything more than we've heard from Elon already on version 12. He'll probably be explaining it to people that maybe don't follow quite as closely, the stuff that we've already heard, which I think is good. Maybe we'll hear a little bit about Optimus. I know Tesla had said on the last earnings call that sort of the production level actuator was, ready to go into sort of mass production, kind of targeting November for that. So we're not quite there yet, but maybe we hear an update on the progress there. Obviously, we just had that video from Optimus a little bit ago from the Optimus Tesla X account. So those would be kind of the main things that I would keep an eye out for. And then, it'll be interesting this call, of course. This will be our first one without Zach Kirkhorn, unfortunately. But looking forward to hearing from the new CFO. Obviously, been with Tesla for a long time as well. So it'll be nice to just kind of get his perspective and see how that kind of flows into the earnings call, as well as that's usually our primary time to get updated from the CFO. So yeah, I think a lot to look forward to. Obviously, this isn't the most exciting quarter on a financial basis with some of the downtime and Tesla kind of still working through the level setting of pricing and demand and how it all fits together with this sort of new environment that we're in. We opened this talking about GM and the impact on their business and their business decisions from the current environment. And, that impacts Tesla too. Obviously, there's a lot to talk about with profit optimization that we've spent a lot of time on, but regardless of anything that Tesla is doing on that front, this was always going to impact them. The macro economy was always going to impact Tesla. It's just a matter of the degree. So, you know, we're working through that period. It's not a lot of fun. And you can see if we go down through the, you know, the EPS line, this is a pretty significant decline year over year. You know, if my number is anywhere in the ballpark, or the analyst number is anywhere in the ballpark, down 28% year over year. Not super fun to see that when you've got deliveries up 27%. So again, you know, we're kind of level setting from that period of time where things were, you know, kind of bubbled in terms of pricing. Now it's maybe hopefully more towards the trough end of that. And hopefully we get some stability as we work forward from here. But that will mean that the price to earnings ratio declines unless we see a significant decline in the stock price. Hopefully not. But you can see here, if we just look at the gap line, earnings per share of, you know, $3.53 over the last 12 months, but you're replacing 95 cents with potentially something in the 60-cent range, obviously pending Tesla's number, which would move, if my forecast is close, move us down from 353 to 320. So obviously that'll change the denominator for the price to earnings ratio calculation, and it'll push the PE up a little bit. But again, a lot of that a factor, downtime a factor in a lot of that. And of course, just the macro environment. So we'll see. But those are, again, helpful pieces of context to kind of keep in mind. Winston, thank you. I really appreciate that. Always super supportive. So thank you. I appreciate that a lot. Jack got a super chat here. Hey, Rob, do you think the September downtime in Austin, the lack of night shift in Berlin, and the lower September Y production in China could indicate lower demand for the Y as Tesla slows production to match with orders? Yeah, I think that's probably oversimplifying it. I think Tesla probably makes their decisions on how they want to do things at their factories based off of how urgent it is to sort of fulfill, you know, orders. If orders are coming in a little bit lower, it's probably an easier time for Tesla to do things like take some downtime to, you know, improve things that maybe are adding costs. So I think that's probably what we're seeing right now in Texas and Berlin. Maybe not both factories equivalently, but I think that, you know, orders are going to and should influence those decisions that Tesla's making. If Tesla had a 6-month backlog on Berlin production, on Texas production, they'd probably push things a little bit harder, versus if they don't, if it's a few weeks, they know they can, you know, take some time to maybe optimize some other things in terms of cost, which would be a smart thing to do. So I wouldn't put it as black and white as, you know, oh, there's not enough orders, we're going to shut down the factories. I don't think it's, you know, definitely wouldn't put it that way. I don't think that's the case at all. But I think, you know, strategically, you're going to make different decisions based off of how big of a backlog you have. And obviously right now, Tesla's not sitting on a huge one just based off of delivery, order windows and price changes and all the stuff that kind of indicates that. So, you know, it's a good question and a good thing to keep in mind. And it would be awesome if Tesla would, well, I don't know if it'd be awesome if Tesla would share a little bit more on that, because it's something that, you know, the market can kind of overreact to some of those things a lot of the time. But I'm sure it's things that, you know, Tesla's considering and factoring into the decisions that they're making. But really good question on that. Got a funny comment here. None of this matters, LOL. So, I mean, I know it's probably a little bit tongue-in-cheek comment. And to an extent, I agree with it, right? Like, it doesn't super matter if we come in at 59 cents or 62 cents or whatever else, especially in a period of time where you've got downtime that's going to impact these things. You've got ramps like the 4680 ramp, Cybertruck, all these things are going to influence the financials. But broadly speaking, you know, the financials over a year, like what we've seen unfold on this sheet, obviously those things matter and give us a sense of what's going to happen with the business, right? Like it's been pretty apparent that, you know, earnings per share were going to be declining or kind of stagnating this year for quite some time. We've been talking about that. So how relevant that is to the long term, that's certainly debatable. May not be relevant at all. Certainly if FSD makes continued progress, maybe none of this does matter, but it's Tesla Daily, right? Like we want to understand how things are progressing day to day and hopefully frame that in a long-term context. And hopefully going through these things in this level of detail helps with that understanding, which again is really the whole point. It's not to try to get the number dead on and like beat all the other people on Twitter. Like I couldn't care less about that, but it's helpful to just understand, the context of the business. So, all right. Well, I didn't really intend to turn this into like a Q&A thing, but hopefully everyone feels good going in tomorrow, just like kind of understanding some of the impacts. Again, I'll point out to the FSD deferred revenue. That's a big influencing factor in my forecast. And then just when we look quarter over quarter, you got to keep in mind that $328 million of impact last quarter on the other income line. Tesla did also note, this was a year over year change, the negative impact of foreign exchange in terms of average selling prices. I'm not great at forecasting that, unfortunately, so it's always kind of a wild card, but it also impacted in other areas other than just that operating income line. So we'll try to keep an eye out on updates for that tomorrow as well. All right. Well, that'll wrap it up for today. So as always, thank you for listening. Make sure you're subscribed and signed up for notifications. You can also find me on X @Tesla Podcast. And we'll see you tomorrow for earnings for the Wednesday, October 18th episodes of Tesla Daily. Thank you.